Good evening, friends. In the present lecture, we are going to discuss foreign investment, FDI versus FII. If we look at the international finance, last 25 years, we have seen various examples where the foreign money has created havoc in the countries, and in some cases, it has supplemented the economy as well. So there are two views on it, and very strong views on both sides, with both merits and demerits on both sides. Now we can have various examples can start it from Mexican crisis 1986, then 1997 East Asian crisis starting from Thailand and spiral effect into various other economies, and then Russian ruble crisis, and then in the recent last 5 to 10 years we can have European crisis, the Greece crisis, the Scandinavian countries, the Ireland economy. So this has been a very volatile topic to be addressed, and how it has to be addressed, various countries are still gripping with the problem, and Indian economy is also facing the same problems. Now before going into detail into the lectures, I would like to draw a caveat here that we are going to do a feature on foreign investment in India. Then we are going to minutely look into what is happening in Indian economy, but as of now it is more of an introductory lecture. So let's start with the right from the definition itself, that IMF defines FDI as acquisition of at least 10% of ordinary shares or voting power in a public-private enterprise by non-resident investors. A very simple thing, we can rephrase it. FDI is a direct investment into production or business in a country by an individual or company in another country, either by buying a company in the target country or by expanding operations of an existing business in that country. So there can be three types: vertical, horizontal, and platform FDI. The types: the horizontal FDI, when a firm duplicates its home country based activities at the same value chain in another country through FDI. For example, Toyota sets up a plant in Bangkok to manufacture cars and cater to Thailand market, and opens another plant in India to cater in Indian market. This will be called as horizontal FDI, meaning within the same country. And vertical FDI is when FDI is made in a country to move up and down a stream of existing value chains in a company. For example, Toyota is making cars in Bangkok and sets up a plant in India to manufacture some of its part, and then they are shipped back again to Bangkok. The investment will be vertical FDI. The platform FDI, FDI from a source country to destination country for the purpose of exporting to third country. For example, Toyota invests a plant in India with the sole purpose of exporting cars to some other country. Now, what is foreign institutional investors? Foreign institutional investors, an investor or investment fund that is from or registered in a country outside the one in which it is currently investing, is called foreign institutional investor. The term is most commonly in India to refer to outside companies investing in financial markets in India. So it's a very simple term that for companies investing in the financial markets of India, usually FIIs invest in the stocks and debentures of Indian companies. In order to invest in primary and secondary capital markets in India, the funds must get themselves registered with SEBI first. This is the priority requirement. And now the cap on it, the general cap of FII investment is 24% of paid up capital of Indian company, but for public sector banks it is 20% paid up company. Now I would also like to draw that RBI has also mentioned it, that 10% for NRIs and PIOs, that is persons of Indian origin. So, and RBI does day-to-day monitoring when the cap reaches 2% and close to the maximum ceiling. For example, it is 24%, then RBI will be worried when it is at 22%. And when in public sector bank 18%, RBI will definitely have a close monitoring about it. And for example, I would like to say that these are investment usually engaged in foreign institutional investment in mutual funds, hedge funds, pension funds, and insurance houses. So now how about depository receipt. Now depository receipt is a very simple phenomena, and I would like again to draw a caveat here that there can be Indian depository receipts as well. So you don't limit yourself that there are only three types which are being displayed on the screen now. So a depository receipts, by definition, is a negotiable certificate issued by a bank representing shares in a foreign company traded on a local stock exchange. Simply meaning, a depository receipt gives investors the opportunity to hold shares in the equity of foreign countries and giving them an alternative to trading onto an international market. Simple. And now the DR, which is originally a physical certificate, allows investors to hold shares in equity of other countries. Now with this definition, everybody must be having a very clear-cut idea. Now most of the common DRRs are American Depository Receipts, which has been offering companies, investor, traders global investment opportunities since 1920s. So this year can be learned that how you can learn on this year. Now American Depository Receipts, if depository receipts are issued and traded in America, it is called American Depository Receipts. If the global depository receipts are issued and traded in a country other than America, it is called as global depository receipts. And European depository receipts is European countries issuing depository, getting them traded in Europe is called as European depository receipts. Now since the time we spread to other parts of the globe in form of, the most commonly are European DRs, international DRs. ADR is typically, I have already said, in US such as the New York Stock Exchange, and GDRs are commonly listed on European stock exchanges or London stock exchanges. And both ADRs and GDRs are usually denominated in US dollars, but it is not necessarily, it can also be denominated in euros as well. So now coming up, because separate lecture can be done on DRs. So now we are coming to the conclusion about it, how these things happen. Now FDI is an investment now versus FDI versus FIIs. FDI is an investment made to acquire lasting interest in enterprises operating outside the economy of the investors. Point number one. Second is the FDI relationship consists of parent enterprise and a foreign affiliate which together form a MNC. Now what this means literally is that FII generally means portfolio investment by foreign institutions in a market which is not their home country. These institutions are generally, I've already said, mutual funds, investment companies, pension funds and insurance houses. And their investment are in stock markets, whereas FDI are generally long-term commitment to a particular company in a sector in terms of equity investment by some foreign entity. And now last point, which can be of note, that FII funding is buying moves to stocks in a day, and FDI has long-term commitment, hence we see flight of capital in terms of FIIs outflows but not generally in FDIs. Thank you very much for listening. Looking forward to your active participation and support. Thank you very much, and good wishes to all of you in all your future endeavors.